Every trading day, millions of shares change hands in a chaotic auction. That auction generates a market price, but this figure is a temporary clearing mechanism driven by immediate sentiment. As Warren Buffett observed, price is what you pay, value is what you get. Intrinsic value is an analytical estimate derived from a firm's future cash flows and underlying assets. Research analysts quantify the divergence between market price and actual intrinsic value to identify mispriced securities with a margin of safety. To find this value, analysts use a dual framework: absolute models like discounted cash flow and relative market heuristics known as multiples. Calculating a company's worth requires building a mathematical model from first principles before abstracting that data into comparative market shorthand. Financial valuation assumes the current value of a business equals the present value of its expected future cash flows. This discounted cash flow pipeline projects cash flows 5 to 10 years out, pulling sums back to year zero to determine today's worth. The dividend discount model measures cash paid to shareholders, used for mature stocks with reliable payouts. Free cash flow to equity tracks residual cash for shareholders after capital expenditures and debt are met. Free cash flow to the firm calculates total cash generated before debt repayment. Cash flow projections are only useful if adjusted for the time we wait and the risk they might not materialize. The discount rate serves as the penalty applied to future cash flows, based on the specific risk of the company's capital structure. Valuing equity uses cost of equity via the capital asset pricing model, adding a market risk premium onto a risk-free baseline. Beta adjusts this premium, measuring the asset's sensitivity to market volatility. Valuing the entire firm requires the weighted average cost of capital, or WACC. WACC proportionately blends the required returns of shareholders and lenders based on the firm's capital structure. The discount rate determines the sensitivity of the model. A fractional increase in perceived risk can erase massive amounts of present-day value. No company sustains hypergrowth forever due to eventual market saturation and competition. The window where analysts confidently forecast high-growth cash flows is the projection period. Beyond year 5, we calculate the terminal value, an estimate of all cash flows generated from that point until the end of time. The Gordon growth model calculates this perpetuity by assuming cash flows will grow at a stable, constant rate forever. This perpetual growth rate cannot logically exceed the broader economy's long-term nominal GDP growth rate. Since terminal value accounts for up to 80, analysts balance the assumptions of the DCF model with a secondary, reality-based heuristic: relative valuation. Standardized multiples allow for peer-to-peer comparison by measuring what we pay against what we get. The price-to-earnings ratio is common, but it ignores differing growth rates. Dividing the PE by a growth trendline creates the PEG ratio. The PEG ratio allows for accurate comparisons between high-growth tech stocks and slow-growth incumbents. Enterprise value to EBITDA evaluates core operating performance before interest and taxes, making it useful for comparing firms with vastly different debt levels. For banks, analysts use the price-to-book ratio, as their liquid monetary assets make book value a reliable proxy for worth. Multiples indicate whether a stock is cheap or expensive relative to the current market mood, rather than calculating an absolute intrinsic value. These metrics become difficult to apply when conglomerates operate disparate business models under one corporate umbrella. The sum of the parts methodology values each business vertical as an independent firm, using its own specific multiples, then aggregates them into a total sum. Analyzing complex entities requires stripping them down to discrete units to ensure a failing segment is not disguised by a profitable one. Research analysts triangulate value by using the absolute logic of the DCF as an anchor and the relative reality of multiples to gauge the market. Mathematical complexity in these models can create a false impression of precision. Small adjustments to a terminal growth rate can change an asset's status from undervalued to overvalued. As Benjamin Graham and David Dodd noted, even careful projections can be seen as only a rough index to the future. Every valuation remains a point-in-time estimate, heavily dependent on the specific inputs selected by the analyst. An analyst's competitive edge comes from the qualitative judgment used to select inputs. While models build the framework, human deduction finds the margin of safety.